Do you know there's an account that will pay you 4 to 6% a year compounding interest, and you don't have to pay taxes on these earnings? This account comes with other benefits as well, including maintaining access to your capital. Capital has to reside somewhere, and whether you know it or not, you have a choice to hold your money in account A or account B. And a common place to hold liquid cash is account A, which is a bank account. You get paid a small fee worth absolutely nothing to let someone else use your money and make exponential profits. But did you know you can make money off of your money instead of letting the banks and credit cards make all that money? You can grow your money at 4 to 6% a year even though you're using your money somewhere else. And remember, you don't have to pay taxes on that money. This system also gives you long-term care protection, critical care protection, and gives your family a large amount of cash when you die. Now, have you ever thought about where banks hold their money? It's called BOLI, Bank-Owned Life Insurance. Banks hold up to 40% of their Tier 1 capital inside high cash value dividend-paying life insurance policy. Now, we're not talking about using life insurance as an alternative to the stock market. We're talking about a properly structured permanent life insurance policy being used as a safe alternative to a bank as a holding tank for your cash. Now, banks and corporations put hundreds of billions of dollars into life insurance. The top 5 banks alone have over $73 billion in life insurance. And whose money do they put in? They put in your money. But we've always been told life insurance is a terrible place to put our money. So why do banks put so much money into it? It's because of the safety, the tax benefits, and the predictable growth. They use the cash flow from these policies to pay for expenses such as employee benefits and retirement plans. So you put your money into the bank, they either lend it out and make massive profits, or they put it into life insurance. Then when you need money, the bank borrows against their policy, lends you that money, and charges you a premium for it. So they make massive profits for lending you your own money. Now the bank makes money inside of the policy through the dividend, and it's making interest from the money you're paying them. So the banks and corporations are making money in multiple places at the same time. Shouldn't we mimic what the banks are doing? Instead of thinking about life insurance as an expense, think of it as a deposit and an investment for the future. You're always going to get your money back. And yes, there are some upfront costs. This is life insurance. But the benefits and future benefits outweigh the cost. You get tax-free use of money, uninterrupted compounding growth, critical care, and if you pass away unexpectedly, your family gets a tax-free death benefit. So let's look at what a policy actually looks like. This is a healthy 45-year-old male. Total premium or total deposit is $100,000 a year. And no, you don't have to put in $100,000 a year. I've got a couple other examples putting in less. The dividend each year, and what you'll notice, year 10, this policy's paying out almost $34,000. Year 15, almost $60,000. Year 20, almost $95,000. And as long as these policies are structured correctly, you'll never have to pay taxes on that money. The next column is premium outlay. That's the total amount you put into the policy each year, and that's including any loans that you've taken against the policy. Next column is cumulative premium outlay. The next column is total cash value. So we see we put in $100,000. We've got access to about $78,000. So when we design these policies, we try to have cash value available from day one of about 75 to 90% of the total deposit. And we have what's called a break-even year, which means the total cash value available exceeds the amount of money that you've actually put in. And typically we try to get these break-even years between year 5 and 7. And in this particular case, year 5, we've got $496,000 cash. In year 6, we've got $621,000. So our break-even year was between year 5 and 6. And if you go down to year 11 to 12, you deposit $100,000, but the cash value grows by $171,000. And the more you deposit, the more efficient your money becomes. We look at year 25, depositing $100,000, and the policy grows by almost $324,000. And then, of course, we've got the death benefit. This is an example of a 30-year-old healthy male. This is for illustrative purposes only. I just want you to see the tax consequences of keeping money inside of a savings account and the growth differences between a savings account and a life insurance policy. Now, on the left-hand side is the bank account, putting in $6,000 a year. And at the end of 30 years, got about $205,000. And you notice the taxes you'd be paying on that just for holding money inside of a savings account. So you're being punished. We look over at the life insurance policy. Of course, we don't have access to all $6,000 from year 1. But again, our break-even year is between year 5 and 6. And by year 6, we've got more cash available than what we've put in. We go down to year 10 to 11, put in $6,000, cash value is grown by almost 10. Go down to line 25, and the cash value is growing by almost $20,000, even though we're only putting $6,000 in. Now, the two advantages that a savings account has over a policy is it's more convenient. You can go down to an ATM or your local branch and grab some cash, and you have access to 100% of your cash from day 1. Now, on this life insurance policy, it starts out with $217,000, and by age 55, the benefit is over $690,000, and by age 70, death benefit is over $1 million. So the death benefit continues to grow as well. In this example, we're looking at a 38-year-old healthy male putting in $25,000 a year. On the left-hand side is a bank account. After 30 years, got about $843,000. You can see the taxes being paid every year, and it ended up being almost $32,000 in taxes over this time period. So again, being punished for saving money inside of a life insurance policy, or inside of a bank account. I apologize. We get to the life insurance policy. Put in $25,000 a year. Year 1, we've only got access to $16,000, but by year 8 or 9, the policy ends up breaking even. We go down and we look at year 20 to 21, put in $25,000, and the account grows by over $61,000. And we go to look at year 29 to 30, put in $25,000, and the policy is growing by over $90,000. If we want to use this as a retirement account, start taking money out every year, the policy continues to grow, and we can take out about $2.5 million. Never risked any money, always had access to this money. And what's great about a life insurance policy is it's an and asset, meaning you put $1 in and it goes to work in multiple places at the same time. It means you borrow against your policy and your money continues to grow. You can borrow this money for anything you want. Car, vacation, rental property, every other cash flow businesses. Life insurance company doesn't care what you use the money for. It's your money. And ultimately, the features of a properly designed high cash value permanent life insurance policy allows you to build what's called a family bank, and it's often referred to as infinite banking. Now, when you borrow against your policy, you're actually borrowing from the life insurance company. You're not borrowing from your policy. And this allows your money to stay inside your policy, continuing to grow. So you're borrowing from the life insurance company in a similar fashion that you do a bank. Instead of using a car, house, or other asset as collateral, the life insurance company uses a portion of your death benefit as collateral. So it acts more like a line of credit than it does a loan, because as soon as you put money back into the policy, that money is available for you to use. And when you need a loan, there's no credit check, loan to value on your real estate doesn't matter, debt to income doesn't matter, credit score doesn't matter. You control when and how you pay back the loan. And you can't be turned down for a loan. And because you own this banking system, you're making all the profits, not another bank. So instead of shifting your wealth to banks by sending them all your money, you're redirecting all the money back to your pool of money that you own and you control. Now, the reason you don't have to pay taxes on the earnings is because we take them out as, so yes, you do pay interest when you borrow money. No, you don't pay yourself. Pay back the life insurance company just like you would a bank. And the interest costs are typically lower. Due to the nature of simple interest you pay on the borrowed money compared to the compounding interest you earn inside your policy, the growth inside your policy will outpace your borrowing costs. You end up creating positive arbitrage, and the net effect is you create a profit. And not only that, because you're a policy holder of a properly structured life insurance policy from a mutual company, you're considered an owner. And as an owner, you receive dividend when the company makes money. Now, dividend isn't guaranteed, but the companies we use have been paying a dividend for 150 to 175 years. So that's a pretty good track record. Now, we've been told that we must rely on traditional banks and to put our cash inside traditional banks. This isn't true. Start your own family bank as an alternative place to keep your cash and control the banking function in your life. Spend your money throughout your life and create tax-free cash flow both throughout your lifetime and in retirement. Control the terms of your loans. Redirect all the money the banks and the credit cards are making off of you back to you and your family.